Hello everybody. In this video we're going to talk about the difference between accounting profit and economic profit. And as many of you are probably already familiar, when you're thinking about accounting profit or how much money a company makes, you're taking the difference between all the expenses a company incurs and you're subtracting that from the revenue that comes into the business. So when economists look at profit, what we call economic profit, it's a little bit different concept. So we're going to get into the difference between those two particular ideas. And before we can delve into accounting and economic profit, first of all, we got to talk a little bit about the different types of costs that we have classified. So first off, we have what we call explicit costs, and those are opportunity costs of resources employed by a firm that are made with cash payments. So if you think about a company like Domino's Pizza, well, if they're creating a pizza, they have all kind of different explicit costs. They have to pay a company for the cheese. They have to pay for the dough, the sauce. They have to pay their workers' salaries. Maybe they have to pay the rent on a building that they're leasing or using. So these are all payments that they have to actually pay in cash or write a check to somebody else. So those are their explicit costs. But in addition to those, they also have what we call implicit costs. These are the type of costs that don't necessarily have a cash payment, but they're there nonetheless. If you're the owners of a Domino's franchise, well, you invested in that company. The money you invested in your franchise, you maybe could have invested somewhere else. So you could be making a profit on some other type of investment if you didn't invest in the pizza shop. Also, the owner of a company doesn't necessarily pay themselves an hourly wage. They could be working somewhere else for somebody else. Well, they're not making that money because they're employed at their own business. That's implicit cost. They're giving up those wages. Now, when an accountant prepares a financial statement to figure out the profits for a company, they don't take into account those implicit costs. They only look at the explicit costs. So we're going to talk about how accounting versus economic profit actually differ from each other, and it really revolves around that idea of explicit versus implicit costs. So first of all, looking at that accounting profit, again, that's your total revenue minus explicit costs. So total revenue is the money coming into your company. So in the case of Domino's, if they sell a pizza for $10, that $10 are paid by the customer for a pizza. That's their revenue on that particular product. All right, the explicit costs are all the costs associated with producing that pizza, right? The amount they paid for the cheese and the dough and all that, the amount they paid their workers to actually create the pizza, the rent on the building. So all those things go into that calculation for accounting profit. Notice economic profit actually includes some extra stuff. It includes those implicit costs. All right, so it's the opportunity cost of all resources. So we have a term called normal profit, and this is the accounting profit earned when all resources earn their opportunity cost. So generally when we deal with perfect competition, and perfect competition is a situation where we have many sellers in a particular sector of the economy. So an example of perfect competition would be the market for grain or the market for wheat. If you think about those products, there's thousands of farmers selling grain and wheat. So you have a lot of different producers of those products. All right, that's a characteristic of perfect competition. In that type of scenario, we'd expect there would be a normal profit. So the easiest way to actually understand these concepts is to work through an example. So let's take a look at one particular example. So in this particular case here, we're dealing with a lady, Wanda Wheeler. And Wanda was an engineer. She worked on airplanes, creating the wheels for airplanes. Now she worked for a company, and she was making $50,000 a year working for that particular company, but she had a good idea. She had a better way of actually building an airplane wheel, and she wanted to start up her own company to produce these wheels. So she went into business, she started producing them, and she had explicit and implicit costs. So we want to talk about what Wanda's accounting profit was and what her economic profit was, just to highlight the difference between these two concepts. So remember, first off, we're going to look at accounting profit. And accounting profit is your total revenues minus those explicit costs. Explicit costs are just costs that we're actually paying to other people, writing a check, or we're paying cash to somebody else, explicitly paying for some type of good or service. So Wanda had $105,000 in revenue. So that's the money that came into her business from selling these airplane wheels that she designed. Well, she had some costs, some explicit costs first off associated with making that revenue. She had an assistant working for her. That assistant made $21,000 a year. That's a cost that Wanda's paying out of her pocket. She's writing a check every 2 weeks or every month to pay her assistant's salary. So that's considered to be an explicit cost. Also, there's material and equipment. She's selling these airplane wheels. She has to pay for the materials to go into producing these wheels. That cost her $20,000. She's writing a check to the producer of those different products and those the different materials she used in her production. You can see here her accounting profit is that total revenue, the $105,000, subtracting out her explicit costs. So if you take $105,000, subtract out $21,000 for the salary, subtract out $20,000 for the materials that she used to produce the airplane wheel, well, her accounting profit is $64,000. And that's typically what most people in the business world think about when they think of profit, that accounting profit. If you look at a income statement prepared by an accountant, you're going to see accounting profit. You're not going to see economic profit. Economic profits are usually just talked about by economists. So let's look at the difference now between that accounting profit and economic profit. Remember, accounting profit only subtracted out those explicit costs from total revenue. Economic profit takes total revenue, subtracts out not only explicit costs but also implicit costs. So let's look at Wanda's implicit costs. Well, she left her job where she was making $50,000 a year. So if she didn't start up her own company, well, she'd still be getting $50,000 worth of paychecks. She left that job, so that's an opportunity cost. That's an implicit cost. You're not going to see that on the accounting statement for Wheeler Dealer Productions, but that's still a cost nonetheless in a very abstract type of way, so we consider that to be an implicit cost. Also, she took some money out of the bank to invest in her business. Well, she could have been making profits on that money she took out of the bank elsewhere. She could have made other investments with it. All right, so that foregone interest on that savings was $1,000. If she didn't take her money out of the bank and start up this company, she would have been making $1,000 in interest. All right, that's an implicit cost. Also, foregone garage rental. So in this example, Wanda is actually using her garage at home to run her business out of. Well, if she didn't run her business out of, maybe she could have rented that garage out for $1,200 a year, let's say. So that's another implicit cost. That's some money she could have been making, but she's not because she's running the business. Again, these implicit costs wouldn't show up on an accounting income statement, but they are costs that you need to take into account if you're starting up or running a business. So if we want to calculate out that economic profit, we take the revenue of $105,000, subtract out the explicit cost, that gives you $64,000. Remember, that's our accounting profit. Then we subtract out all the implicit costs. So $64,000 minus the $50,000 in foregone salary, minus the $1,000 in foregone interest, and the $1,200 in foregone money that could have came in for the garage rental. That gives us an economic profit of $11,800. So our economic profit's a lot lower than that accounting profit. And that's generally going to be the case. Now, we talked about that idea of normal profit. Remember, we had the definition here, accounting profit earned when all resources earn their opportunity cost. So normal profit would actually be zero economic profit. And that's kind of a strange idea for students when they're first thinking about these concepts, that you'd have a zero economic profit. But a zero economic profit is actually normal in the long run. That doesn't mean the company isn't making any money, right? In this case, she's making an accounting profit. She could have had a zero economic profit, though, if her old salary was a little bit more. So normal profit is zero for firms and perfectly competitive firms in the long run. So that highlights the differences between accounting profit and economic profit.